Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me at the market site, we have Jeff Collins, managing partner at Cloverlay, Rohit Vohra, head of global wealth alternatives at Principal, Raphi, Schorr, partner and deputy chief investment officer at HighVista Strategies, and Mike Guarnieri, managing partner at Evolution Credit Partners. They join me to discuss the private market environment in attractive areas for investment and emerging opportunities. Gentlemen, it's great to have you with us. Welcome to TradeTalks, and certainly a big topic in the marketplace when we think about private markets, whether it's real estate or credit. So let's go around the horn here, Rohit. I'm going to start with you. General thoughts on the state of the industry right now and a brief overview of where Cloverlay is within the ecosystem.
So Principal has been
I'm sorry, Principal.
I understand. Principal has been an investor in real estate for more than 8 decades. And over this time period, we have been now focusing on all the 4 quadrants of real estate investing. We are very glad from a real estate investor perspective that 2023 is behind us. Looking at 2024, we look at it as a year of transition. With interest rates peaking, we look at it as the first half of 24 being a lender's market and being a catalyst in getting the transactions starting to move again in the real estate market, which were pretty much on a screeching halt in last year. And on the back half of 24 is going to be interesting from an equity perspective as price discovery is kind of reaching its bottom. We think 24's back half will give very interesting opportunities to come back as an equity investor into these markets.
All right, thank you. Rohit from Principal. Apologies for that. Jeff, now Cloverlay.
Thanks for pulling this together. So Cloverlay occupies a pretty unique corner of private markets in that we acquire and control esoteric private market assets that might be tangible or they might be intangible, but they're not frequently operating businesses. They're the actual assets. So think about intellectual property or obscure corners of litigation finance. So there are lots of dynamics in our world that are impacted by what's going on maybe in everyone else's day-to-day lives, but it's less acute and less fewer trends to follow, and it's more opportunistic and looking for emerging opportunities.
All right, and we'll get to that shortly, of course. And Raphi, tell us about HighVista Strategies. What are your thoughts on the private market space right now?
Yeah, happily. So HighVista's almost 20 years old, and one thing we've learned across 2 decades is that change is a constant. Markets are always evolving. Investors are always looking for new opportunities, and they want to be on the cutting edge, looking for outsized returns. Investors appreciate that those are typically found in emerging areas, in new markets, in markets that are less competitive or less efficient. We help our investors by investing in specialized forms of alternative investments. We're looking at those kinds of less efficient and less competitive markets and gaining access for our investor base to those markets.
And Mike, from Evolution Credit Partners perspective.
Yeah, thanks, Jill. So we do find the private credit environment to be attractive right now. We have 2 areas of focus. We focus on acquisition financing, and our point of differentiation is we invest across the capital structure. So we can invest in first lien secured down through mezzanine capital. In addition, we also do working capital financing. So that'll be supply chain financing, accounts receivable factoring, and inventory financing. So anything in that working capital chain for borrowers who have a longer cash conversion cycle. So what we like about the environment right now is the issuers are gravitating toward private capital solutions, and we go to market with 2. We could show them 2 corporate financing solutions, either on the acquisition financing side or on the working capital side.
Let's talk about why private markets, credit in particular, has really garnered recent interest. Does it have anything to do with some of the banking fallout we saw earlier in 2023 and companies are looking for alternative forms of financing? Why do you think we're starting to just hear more about it in the mainstream?
Yeah, it's a great question. I think first and foremost, many of the borrowers need a private capital solution because they need something that may not quite fit the syndicated markets. And in fact, what we found is a lot of the banks and investment banks want to partner with private credit funds, such as ours and numerous others. But to me, the real interest in private credit all of a sudden really lies in the returns and availability, right? They've been attractive throughout long measurement periods, a steady source of income, and there had been this perception that they were risky, but when you look at the default data and their credit losses, it doesn't prove out, right? So because of that, it's gone from an asset class that really was restricted to pension funds, endowments, and foundations, and has now become broadly available to the retail sector through numerous different vehicles. So that's why I think the interest levels picked up.
Yeah, and Rohit, when we think about it from Principal's perspective, private real estate, that's the largest private market franchise that you have at Principal. Tell us why you think it's continuing to garner the interest that it has, especially in a challenging commercial real estate environment.
Yeah, I think from our perspective, you brought up private corporate credit. I don't see private real estate debt being talked about that much, and that is a huge opportunity for a lot of the reasons you were mentioning. So large bulge-bracket banks had first pulled back from providing commercial real estate debt. After the SVB and Signature Bank, regional banks have pulled back. So that's created a demand-supply imbalance, and that's the reason transaction volume got impacted in the real estate sector. From a private debt perspective, that's a huge opportunity, and it is getting even more attractive. The refi wall coming of commercial loans over the next 3 years is close to $2 billion. And we have no idea how that is going to be plugged in. And from that perspective, you have an opportunity to be a lender in this market and garner better spread widening that is taking place, and also do it at a lower risk because equity owners are willing to accept a much lower LTV than from what it was 2 years ago.
Yeah, and Jeff, it was interesting you have brought up that you're typically not in the areas that you would think of when it comes to private market investing. Tell us more about that. It almost seems like the intangible worth of some companies. I thought that was interesting.
Well, we're 2 for 2 on talking about what's a really solid sort of asset allocation today away from public debt to private debt. Not a secret, and lots of capital coming into what is an interesting risk-adjusted return. We like to go where the money isn't going. And the money isn't flowing into the off-the-run esoteric strategies. It's retreating to core, and that's driven by the largest LPs in the world, but mostly in the United States, where as making money felt easy, they would get more and more adventurous, and they'd get into insurance strategies, and they can get into litigation finance and some of the other things we talked about. When the world becomes uncertain, they flight to safety and liquidities at a premium. So in our worlds, what's the easiest capital to raise in private markets? Secondaries funds and GP solutions funds. Secondaries funds because they're by far the most liquid thing that you can do in true private equity. GP solutions funds, rapid evolution, boom. This is financing at the management company level for previously privately held companies. That's innovation, but it also has a blended return that's sort of unique as you look across the private market landscape. The rest is tough unless you're a $10 or $15 billion fund trying to master of the universe. Those can be raised.
Yeah.
But the rest of the fundraising market is really tough as the largest LPs just sort of say, I didn't do anything in 2022. I also didn't miss anything in 2022. So what's the rush? So they sort of are tapping the brakes and staying in what feels safe.
So it sounds like macro conditions that impact the public markets, there also is an overflow to that in the private markets as well. I feel like what's happening in the private markets is kind of a good tell in terms of what you could potentially see in the public markets. I mean, money has to be put to work from somewhere.
Absolutely. It all depends on what part of private markets you play in, and ours in particular. An effect you may see from what's going on in public markets is the ability for larger, slightly unnatural owners of many, many, many assets to continue to finance those assets at a level that has felt really comfortable for a really long time, and all of a sudden, small pieces start falling off the table. Those are the pieces that we go after. I have 30 days to do a $45 million asset transaction, and then I have another one that I need to do 30 days after that. Those are not efficient auctions. Those are inefficient private market trades.
Jill, if I could offer, I think private markets, when we talk about them broadly, offer the trifecta of having strong human capital, governance, and smart and patient financial capital. Those 3 things come together in a wonderful combination to affect change. And it's a good complement to public markets. They're both critical to the overall health of capital markets. And when we think about investing in private markets and the opportunity set, whether it's in private equity, venture capital, or private debt, it's through that lens of where can we combine the human capital, the financial capital, and the governance to create value. That's the point of the private markets.
Right.
This is a great environment for that today.
Yeah.
Nothing's changed in that regard, and whether we're talking about real estate or credit or the uncorrelated or the several different disciplines that HighVista invests in, this is a great environment for that kind of private capital.
Yeah, and Jill, it's sort of interesting. That's a great comment, because one of the things we focused on in building a business out at Evolution, we started a few years ago, is focusing on a funding gap. And we think there's a funding gap that exists in trade finance, right? So these large markets, right? These broadly syndicated markets, whether it's debt, equity, public, private, what still happens is these funding gaps. And so this is why we like working capital lending, right? So to put this in context, right? Working capital financing, right? Which is, again, anything in that working capital chain, accounts receivable factoring, supply chain financing. It had been the domain of the large trade finance banks, even the money centers, some of the regionals. But that capital source was never particularly flexible, right? You've heard the term, you got to fit into a bank's credit box. And furthermore, they were never particularly relevant to below investment grade borrowers, right? And so what happens is you have all these middle market companies, could be private equity sponsor backed, might not be private equity sponsor backed, that are solid businesses with very good fundamentals, good management teams, but they don't have this access to flexible capital. So that's been a really attractive area for us, and we feel like we're lending against high quality collateral. Like we go and do these accounts receivable factoring deals, and we're getting very high quality investment grade borrowers in that pool, and lending against them. So we think it's just a winning combination. Back to what I said at the outset of my comments, to be able to go into a middle market borrower and say, we have working capital solutions to help solve your challenge, or we have acquisition and financing solutions. We think that's a winning combination.
So it sounds as if, regardless of what happened with SVB and other banks in March of 2023, that this is something that is here to stay, that banks are, borrowers aren't just going to go right back to the banks once the financial system levels itself out.
Plus their capital buffers are at much higher levels. They didn't even have the capital to lend anymore.
Yeah, well, I thought you also made an interesting point at the outset as well, where there's more retail products that are available right now, whether it's slicing and dicing the products and so forth, regardless of the asset class, whether it's credit, private credit, other alternative areas. Does that really have an impact on the market? Is there too much flowing into this space at this point that they're just looking for alternative forms for their portfolios? They're not actually structuring these products. There's not as much knowledge behind that.
I'll say we feel like there's a lot flowing into it, but if you put it in dollar terms, there's roughly $400 billion that has come across all these structures, whether it's interval funds, BDCs, non-traded REITs. And you look at that $400 billion relative to, there are two different denominators you can work with. One is the net worth of investors that do not qualify for limited partnership type structures. That, if you look at clients between half a million to 5 million of net worth, you're talking about $20 trillion just in US. So 400 billion is less than 3% of that number. So it's not a lot in terms of client net worth that has gone into that space. And then if I apply a denominator of the overall need of capital from a private market standpoint, that number is even more minuscule. So 400 billion looks big, but when you look at the denominators, whether it's client capital or the market opportunity, these are minuscule numbers.
Well, I would say, first of all, it's important to remember that private credit's not really a market, just the same way that credit's not an asset class. It's a structure, and it's a number of different markets. But if we think about the main part of the private credit market, which is LBO lending, the size of the credit market really is paired with the size of the overall LBO market and that activity. And that's measured in several $1 trillion. And so it makes sense that it will continue to grow as the private equity market continues to grow. I think many of the panelists here, our focus is not on that market, but on more differentiated parts of private investment markets, private credit markets. There are specialized areas where they can be overwhelmed by capital, or they can be underwhelmed by capital. There could be a scarcity of capital. And so our job as investors is to identify those areas where there's capital scarcity, where there isn't abundant capital, where there's less competition, and bring those to our investors.
Well, let's wrap it up and talk about that. In 2024, when you think about the outlook for the private markets, what is most attractive? Are you focusing more on liquid opportunities, less liquid opportunities? Where's the focus?
I think it's actually broadly attractive right now. This is one of those moments in time where we'll look back in a decade and say, why didn't I deploy more capital in 2024? And the answer is because we can't all be contrarians. The bottom of a market cycle is the time where we deploy less capital in general, and that's just generally true. But I think it's attractive for the reasons we spoke about in credit. You see the yield and lower asset values and higher yields is an attractive time to be in credit, but it's also an attractive time to be getting involved in the growth economy where valuations have reset in real assets, real estate, where valuations are resetting. They're in the process of resetting. And it's also true in the corporate world, in the LBO world, where there is a reset that we're currently experiencing, where it will be an attractive time to deploy capital at lower entry multiples.
Right. Well, of course, Jeff, I mean, you want to buy low and sell high in any investment
that's the idea,
that you
Jill.
make.
Yeah, no, I mean, a major theme with many sub-bullets under it for us in the coming year, and also we were very active last year, is intellectual property, broadly speaking. And that's a content statement and also a device technology statement. One of the reasons behind that is the dramatically changing landscape of use cases for both content and device, and the technology inside a device means there are lots of places in the world where there are no rules. Everyone thinks there are rules about how much you get paid for someone else using your IP. Not at all the case. I mean, look at today, Universal Music and TikTok.
Right.
There are no rules about how much Universal should get paid. So
well, on a high level, how do you value that if you're making an investment?
Well, you can look at Spotify and say, we think that's the way the world is going to land. Or you can look at it and say, this is the wild, wild west and two monster companies negotiating against each other. Maybe they'll come up with their own construct and everyone else has to adopt it. So that's part of the evaluation and digging deep into a segment and having a collection of disparate data points to inform your view of we think the right price is here and we think the right pivot is here, but it's hard to tell. It's a rapidly changing landscape.
Yeah.
Intellectual property, that's the move.
That does sound interesting. And Rohit, when you think about 2024 the opportunities, and then also let's factor in what's happening in the macro environment, how much will, let's say, heightened geopolitics in the election in the US and the UK coming up, how could that impact the private markets?
Yeah, I think the biggest challenge we had in 23 was lack of clarity on where will the interest rates peak. I think with the peaking of interest rate, that has definitely helped the market start move again in the real estate space. So as I will agree with Raphi, the price discovery is maybe in its 8th inning now. So as a lender, the first half of 24, we are excited to be a catalyst in getting the transactions moving by being a liquidity provider there and trying to bridge that gap between demand and supply on the debt side. And the back half, we want to be ready to take advantage of the opportunities coming on the equity side as we hit bottom in pricing and then start the recovery from there.
All right, and Mike, we'll give you the last word here.
Yeah, great. Yeah, so I think I'll just keep this question simple and say that when you look at the vintages of private credit recently, so starting even last year, 23, and we, like Jeff, deployed a lot of capital last year. So 23, 24, 25, I think what we're all going to find is that these vintages for private credit will really compete and compare very favorably to private equity, and in fact, perhaps succeed, right? There's just an abundance of opportunities out there. I mean, some are opportunistic, some are in capacity constrained markets, some are in a little bit more mainstream, scalable markets. But there is an abundance of opportunities, and I think a lot of those trends are going to persist, right? Right now, the last couple of months, credit spreads have tightened in rapidly, and it's because the narrative is consistent, right? So the way I think about it is usually when everyone's thinking the same way, somebody's not thinking, right? So so we're out there being opportunistic. We have capital to deploy, and again, we think this vintage is going to be pretty attractive.
All right, we appreciate the insight, gentlemen. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.